Welcome back to the channel, everybody. Today we're going to be building a $10,000 beginner portfolio. We're going to go over the risks, the overall holdings, and then the expected returns for this portfolio. We also are going to assume this person is 25 years old, they have a mid to high risk tolerance, and they also are going to be starting with $10,000, adding $500 a month. We're also going to assume they have an emergency fund set up, which is 3 to 6 months worth of expenses set aside in a high yield savings account. There are definitely some risks when investing in the stock market, such as the prices of the stocks going up and down daily, and there's also economic pressures, such as if the economy is expanding, you could expect the prices to go up, and vice versa. If the economy is contracting, you could expect the prices to go down in general. But the stock market over the last 100 years as a whole has continued to move upwards and appreciate in price, and we can expect that to happen in the future. Now, what is an ETF? Because that is one of the things that we'll be investing in. Well, an ETF is an exchange traded fund. You can think of this as a basket. It's going to hold Apple, Tesla, and Nvidia while allowing you to be diversified and holding those solid companies that you would like to own. Now, if you have a company that you really love and believe in, you should definitely buy that stock because it is a small slice of ownership of a larger company. This can have many perks such as a higher yield or even a higher dividend yield. Stocks can definitely be risky, and a less risky option would be an ETF. And with even less risk, we have bonds. This is a loan to a company or government from yourself that earns a set amount of interest. This is typically for someone who is more risk adverse. I personally think it is important to have both ETFs and stocks in your portfolio to keep it well balanced and give you some upside as well as some additional dividend income. So let's dive right into our portfolio. In this $10,000 portfolio, we're only going to have 5 positions. We're going to be holding VOO, which is Vanguard's S&P 500 ETF. This will be 50% of the portfolio. We then will be holding SCHD, which is Charles Schwab's High Dividend Yield ETF. We'll then be holding Visa, which is a dividend growth stock, which will be 10% of the portfolio. Our dividend stock is going to be Realty Income Group. It pays about a 5.5% dividend yield. That will be 10% of the portfolio. And then we have Apple, which is going to be our growth stock. Now you can see the current values of the stocks are currently listed. And then if you multiply that by our estimated percent of the portfolio, and then we round down, you can see the number of shares that we'll be holding. And there's the formula that was used to do that. So we'll have 10 shares of EOO, 24 shares of SCHD, and so on. And that comes out to $9,435.64, leaving us with a little over $550
Next thing
in
that
cash.
we'll look
At is the average rate of return and expected returns for the portfolio. So if we take VOO's 10-year average rate of return, which is 13.11%, multiply it by the weight of the portfolio of 50%, we'll get just over 6.5%. If we do that for the rest of the stocks and then we add those together, we'll see that we'll have 12.59% expected return based on the past 10 years. Now, if we were to take the $10,000 and not touch it and leave it invested in these stocks and they had the same performance as they have over the last 10 years, it would take you about 6 years for you to double your money. And for you to hit the $1 million mark, it would take you about 39 years. And this is where we're going to see how important those additional contributions are. Now that we're over here on calculator.net, we're going to see how powerful those additional contributions actually are. So we have our starting amount of $10,000. After 1 year, getting our 12.59% rate of return, our additional contributions of $500 a month get us just under $20,000. And if we go to that same 6 year mark where we were just over $20,000 of doubling the initial investment, we're over 3 times higher than that just by having our monthly contribution of $500. Now, if you recall, it took us 39 years to become a millionaire just by letting that sit and compound without any additional contributions. Well, in just 25 years, you're at $1.1 million by having your additional contribution of $6,000 a year. That's just your $500 monthly contribution times 12 months a year. So in that same 39 years, you would have had to wait to become a millionaire off your initial investment. You would have over 6 times more than that by the time that you got to the same 39 years by having your additional contributions. I completely understand that not everyone is going to be able to put $500 away every single month, but if you're able to do $15, $20, $50 a month, that is huge when you're starting to build that first nest egg. And if you've made it this far into the video, I really appreciate it. Go ahead and click the subscribe button to help the YouTube algorithm push my videos out to other people, so hopefully you can help them make the right financial decision for themselves when setting themselves up for the future. Until next time, take care.